Hello and welcome to Sin's Business YouTube channel. Today we'll be covering the options for startup and small businesses. In this lesson, we will learn the concept of limited liability. So we will understand what limited and unlimited liability businesses are, the implications for the owners of limited and unlimited liability, and then we will cover the types of business ownerships, so that solo trader, partnership, limited, private limited company, and we'll understand their advantages and disadvantages. And then we'll move on to learn everything about franchise operations and their advantages and disadvantages. So let's smash this lesson by starting to understand what limited liability means. A limited liability company is a corporate structure whereby the members of the company are not personally liable for the company's debts or liabilities. So that means if a company goes bust, your personal assets are not at risk. In a simple way to protect personal assets, unlike sole trader, the limited liability company does not tie your personal assets to the company. So your personal things are your personal, they has nothing to do with the business. Limited liability company in the UK limits liability to the total value of unpaid shares. So limited liability is a person. So the limited liability company is a person with its own identity. As such, a UK limited liability company can open a bank account, invest, purchase property, and so on in its name as a limited liability company. So limited liability company has a standard structure that the international business community is familiar with. The limited liability company is a credible and trusted business structure. It has an organized management structure compressing the board of directors and shareholders who manage and own the limited liability company respectively. It can accumulate capital quickly by issuing shares upon formation and any time after formation. So there are different types of limited liability companies. So there is private limited company, limited by shares, private limited company, limited by guarantee, private unlimited company, and public limited company. So these are the four different types of limited liability companies. You need to take point and try to remember these. As you know, there might be a couple of adverts during this video, so please don't get annoyed. I would really appreciate it. If you don't like them, simply skip them. The importance of limited liability. Having limited liability is clearly attractive for someone starting business as it reduces the risk. Someone starting as a solo trader will have unlimited liability. This is an obligation on the owner of the business to settle all debts of the business. In this case, there's no distinction between the owner of the business and the business itself. So for solo trader, if the business goes down, then a house will possibly be taken, whereas for limited liability company, they cannot do that because the business has its own identity. So unlimited liability. Unlimited liability involves general partners and solo traders who are equally responsible for debt and liabilities occurred by the business. This liability is not capped and can be paid off through the seizure of owner's personal assets, making it different from limited liability ventures. So if this guy had a solo trader business, and if something went wrong and the business had lots of debts to pay, then his house would be taken for auction to sell it and then pay off whatever he owes. So there are different types of business ownership. The most common ones are solo traders, partnership, and private limited companies. So solo traders, you might be thinking, are, as you know, solo traders are legally responsible for all aspects of their business and are personally liable for their business's finance. While they can keep any profit, they may also have to repay any debts out of their own pocket. So if you're a solo trader, you get to keep all the profit the business makes. But if there is something wrong, then you'll have to pay everything to fix whatever has gone wrong. A solo trader is self-employed, but they are not necessarily the only worker within the business. Solo trader therefore refers to the legal structure of the business rather than the number of employees. So you need to remember that key point. So the advantages of solo trader are: you are the boss. You can keep all the profits. Startup costs are low, especially if you're not aiming to reach the sky with your first company. You have maximized privacy because it's your business. You don't need to tell nobody about your profits, losses, nothing. You have complete control of your privacy. Establishing and operating your business is simple. It's easy to change your legal structure later if circumstances change. You can easily wind up your business. Now, to every good thing there are some disadvantages, and so there are some to solo trader as well. You have unlimited liability for debt, as there's no legal distinction between private and business assets. Your capacity to raise capital is limited because you're a solo trader. The only capital that you are gonna have is from friends and family, and normally banks are not so keen in giving solo traders that much money. All the responsibility for making day-to-day business decisions is yours, so you don't have anybody giving you any ideas or suggestions, so this can be tricky. It can be hard to take holidays because if there's two of you working on a solo trader business, then when you go on holiday, can you trust that person, or will that person be able to take on all the jobs that you're going to leave him? So taking holiday is going to be a massive task. I can't even say that word. You are taxed as a single person. The life of your business is limited. Partnership. A partnership is a form of business where two or more people share ownership as well as responsibility for managing the company and the income or losses the business generates. That income is paid to partners who then claim it on their personal tax returns. The business is not taxed separately as corporations are on its profit or loss. So partnerships come in two varieties. So general partnership. In general partnership, the partners manage the company and assume responsibility for partnerships, debts, and other obligation. However, the limited partnership has both general and limited partners. The general partners own and operate the business and assume liability for the partnership, while the limited partners serve as investors only. They have no control over the company and are not subject to same liability as the general partners are. So these are the two different partnerships that you need to keep in mind. I've also included joint venture for you here. So joint venture is short-term projects or alliance that bring together multiple partners for a project are typically structured as joint venture. If the joint venture performs well, it can continue as general partnership. Otherwise, it can shut it. So joint venture is where two different companies might work together to make something awesome. So for example, McDonald's might work on a joint venture with Subways to build a new business or bring something completely different. So joint venture is when two big businesses normally work, or multiple companies partners come together to make something new. So the advantages of partnerships are fairly easy to set up and maintain over time. Partners can pool their resources to fund the business company startup. Partners can share the workload and reward of the business's success. However, there are disadvantages to this also. Where more than two owners exist, there are bound to be difference of opinions that could threaten the business. So one partner might want one way of doing things, the other partner might want another way of doing things. So that will start a conflict and they might not agree and will result in business going boost. All top partners split any profit and the business generates if the payment is not in sync with each other's contribution to the company. Disagreements can erupt. So one partner might be putting 100% effort, whereas the other might be only putting 30% effort. So if they both get same amount of monies, then there's going to be a problem. Unlike cooperation, which help to shield honors from liability, partnerships have both joint and individual liability. This is, all partners are liable for their own actions on behalf of the company as well as actions of the other partners. So that is a big disadvantage. Even if you haven't done something, you could be held liable for it because your partner's done it on behalf of the company. So private limited company. A private limited company, or LTD, is a type of privately held business entity. This type of business entity limits owner liability to their shares, limits the number of shareholders to 50, and restricts shareholders from publicly trading shares. This is where the owners are liable only to their shares and not the business debt. The advantages are limited liability, so your house, cars and things like that cannot be seized. Restricted sell or transfer of shares, so nobody can sell the shares without your permission and they have to follow certain rules and regulations. Continued existence and tax breaks. Disadvantages are shares cannot be sold on a public stock exchange, limited growth and restricted number of shareholders. I've opened a PayPal account now, so if you've got a couple of spare quids and if this video has helped you in any way, then please donate to me a couple of quids if you like. I will also put this link in description below, so you can just click on it and enter the amount you want to send to me and it'll come straight to me. So thank you. I know a lot of you guys have already done it, so thank you for your help, and it helps me a lot in uploading more and more videos for you. Okay, sole trader or private limited company. Sole trader. So which one is better? So the risks for solo trader are unlimited liability, greater risk of personal loss. Risks for private limited company is that limited liability losses limited to the amount of initial investment. Control. Owner has sole control, can make their own decisions, whereas on private limited company will depend on the proportion of share owned, or shareholders have a say in the running of the business. Profits. Solo traders keep all the profits, and the owner keeps all the profit, whereas for private limited company, profits are distributed according to proportion of shares owned. Privacy. No one has the right to see company details, so privacy is assured and you have total control of that. Whereas in limited company, accounts and company details can be viewed by public, so this is less private. Now let's understand a franchise operation. So franchising is when an established business allows a third party the right to operate using their trade name, either through their manufacturing, distribution, or sales channel. This is usually in return for one-time franchise fee plus a percentage of sales revenue. There are three main types of franchise which we're going to cover now. So the main and common one is business format franchise, an agreement whereby a business franchisor licenses another business, the franchisee, to trade using their branding, business model, and a number of other assets, while also supplying additional supports and guidance as part of the package. Like I said earlier, this is the most common type of franchise. However, there's other franchise types too. Product distribution franchise, for example. In a product distribution franchise, the franchisor, so this is the owner of the business, allows the franchisee, the person that wants to buy the business, to sell their products and licenses their logo for use, but does not provide any ongoing support to the business. Essentially, it works as more of a supplier and seller relationship, but with additional branding. Branded petrol station would be an example of this, allowing their name to be used in supplying gasoline, but leaving business operations up to the franchisee. Manufacturing franchise. A manufacturing franchise is licensed to produce goods and services using franchisee's brand name. Food and beverage companies often operate in this way. So who are offering franchising opportunities, you may be thinking? In the UK, Coca-Cola, Lloyds Bank, Subway, McDonald's, Marston, and there's tons and tons and lots more that I've put here for you, so there's a hell of a lot of them. So what are the advantages of franchise? The risk of business failure is reduced by franchising. Your business is based on a proven idea. Products and services will have already established a market share, therefore there will be no need for market testing. You can use a recognized brand name and trademark. You benefit from any advertising or promotion by the owner of the franchise, the franchisor, so the person that owns the business. The franchisor gives you support, usually as a complete package, including training, help setting up the business, a manual telling you how to run the business, and ongoing advice. No previous experience is needed, as training received from the franchisor should ensure the franchisee establishes the skill required to operate the franchise. So there are some great advantages to franchise. However, there are some disadvantages also. Costs might be higher than expected, as well as the initial costs of buying franchise. You pay continuing management service fee, and you might have to agree to buy products from the franchisor. The franchise agreement usually includes restrictions on how you can run the business, so you might not be able to make changes to suit your local market. The franchisor might go out of business, so that is a big problem. If you have invested lots of money and you have just opened a franchise, next minute the business is gone out, so that's going to cost you a hell of a lot of money. You might find it difficult to sell your franchise. You can only sell it to someone approved by the franchisor. So if you open a franchise restaurant, then you cannot go and sell it straight away. You need it, the person that you're going to sell it to needs to be approved by the franchisor. Even though it's your business, but because it's franchised, you still need to go back to the original owner. All profits, a percentage of sales, are usually shared with the franchisor. So that is another disadvantage, because if you're making 100,000 a year, you might have to pay 10,000 to the franchisor. And now it's time for the questions. Please make sure that you answer these questions in the comment section below. That's how I know that you have learned the key points of this presentation. So I would like you to list 2 types of limited liability companies, list all types of business ownerships, name 2 businesses that is franchise or that are franchise, what are advantages of solo trader business, and what are disadvantages of partnership business. Please make sure you comment them in the section below. Also make sure you subscribe to this channel, like and share, and don't forget the links in the description below. Make sure you send a couple of quids on PayPal if this video has helped you in any way. Thank you for watching, and I'll see you on next video.